Ever thought about investing, but felt overwhelmed by the risks? You're not alone. Today, I'm here to walk you through beginner-friendly, low-risk investment strategies that can grow your wealth without taking huge risks. We'll dive into real-life examples and practical solutions to help you start confidently. Let's begin. Investing can feel intimidating, especially if you're just starting out. But you don't need to take on a lot of risk to make your money work for you. Today, I'll share real stories from beginner investors who took small, low-risk steps to build wealth steadily. By following their journeys, you'll see how to overcome fears and build a diversified portfolio for long-term growth. I've drawn inspiration from real-life stories and common experiences shared by beginner investors in the financial community. These examples are meant to show how small, practical steps can help anyone start their investing journey with confidence. Compounding allows you to earn returns on your initial investment and on the returns that accumulate over time. Even if you start with a small amount, compounding helps it grow significantly. For instance, let's say you invest $1,000 in a low-cost index fund, earning an average return of 7% per year. By reinvesting the returns, that $1,000 could grow to over $7,000 in 30 years. This growth happens without taking on high risks, simply by letting time work in your favor. Diversification means spreading investments across different assets to reduce risk. A diverse portfolio is like having a backup plan. If one investment doesn't perform well, others can balance it out. Imagine Sarah, who initially put all her savings into a single tech stock. She faced a major setback when the company's stock price dropped. After that experience, Sarah diversified her portfolio with a mix of bonds, index funds, and other stocks. This way, no single investment impacted her portfolio's overall stability. Expense ratios are the fees funds charge to manage your investments. The lower the expense ratio, the more money stays in your account, compounding and growing. If you're just starting out, choose funds with expense ratios below 0.5%. For example, the Vanguard Total Stock Market Index Fund, VTI, has a very low expense ratio, which helps you maximize returns. A high-yield savings account, HISA, is ideal for those who want a safe place to grow their cash. It's FDIC insured, meaning your money is protected. Let's look at Kevin, who wanted to save for a down payment on a house within a few years. Instead of keeping his savings in a regular checking account, he moved it to an HISA, earning him a higher interest rate and helping his down payment grow faster without any risk. Certificates of deposit offer fixed returns over a set period, usually between 6 months to 5 years. They're great if you want guaranteed growth without market exposure. Lena was saving for her daughter's college tuition in 5 years. She invested in a 5-year CD, knowing her money would be safe and earn a steady return. When her CD matured, she had grown her savings without worrying about market volatility. Bonds are loans you make to governments or corporations. They pay periodic interest and are typically low risk. Carlos, a retired teacher, wanted consistent income without stock market risk. He invested in government bonds, which provided regular interest payments, supplementing his retirement income without affecting his principal investment. Index funds and ETFs are ideal for new investors. They track the market, so you benefit from broad exposure without picking individual stocks. Emily, a young professional, began investing with an S&P 500 index fund, which holds shares of the largest companies in the U.S. This gave her exposure to a wide range of companies with minimal fees, helping her grow her wealth passively. Building a diversified portfolio with low-risk assets. Creating a low-risk portfolio involves balancing stocks, bonds, and cash. A common approach for beginners is the 60-40 portfolio, 60% in stocks and 40% in bonds. Tom wanted to invest for retirement but was worried about market crashes. He chose a mix of 60% in index funds and 40% in bond funds, which balanced growth and stability. This allocation gave him confidence, knowing that his bonds would provide stability even if his stocks fluctuated. Rebalancing is the process of adjusting your investments to maintain your target allocation, which reduces risk over time. Sophia rebalances her portfolio annually to keep her investments aligned. When her stocks performed exceptionally well one year, she shifted some gains into bonds, preserving her earnings and maintaining her risk level. Practical steps for getting started in low-risk investing. Starting with a reliable brokerage is key. Look for platforms with low fees and beginner-friendly options. Aaron, a recent college graduate, opened a Roth IRA with Vanguard. He chose it because of the low fees and index fund options, allowing him to start with just $50 a month. Automating contributions ensures you invest consistently, regardless of market conditions. Jane set up an automatic transfer of $100 monthly into her brokerage account. This method kept her consistent and reduced the temptation to time the market, helping her stay on track. You don't need a large sum to start. Even small amounts make a difference over time. After watching her initial investments grow, Lisa gradually increased her contributions. She started with $25 a month, but as her confidence grew, she increased it to $100. Her portfolio grew steadily as she learned more about investing. Addressing common fears and misconceptions about investing. Many worry about losing money, but low-risk investments protect your principal. For those concerned, start with insured accounts like HISAs or bonds, which offer peace of mind. Even small amounts grow over time with consistent investing. Ben started investing with only $10 a week. Over a year, he was surprised at the growth, realizing that small, consistent amounts can make a big impact over time. Investing isn't a get-rich-quick scheme. It's a journey. Staying consistent and not worrying about short-term market changes helps investors avoid stress and see better long-term results. Low-risk investing allows you to build wealth steadily without the stress of high volatility. With real-world examples, we've seen how beginner investors like Anna, Kevin, and Lisa use small, low-risk steps to grow their wealth. Remember, consistency and patience are essential to successful investing. If you're ready to take your first steps into the investing world, subscribe for more educational videos and share your questions or goals in the comments below.